So when we talk about subsequent expenditure, I'm trying to let you know that there are some transactions. It will happen after the initial measurement, but you still have to capitalize it. You still have to include it as part of the item of PPE. What are some of these things that will give rise to that? Number one, if that particular item will enhance the economic benefits provided by the asset. Enhancing the economic benefit, you are looking at it in a sense that it will extend the asset useful life, or it will bring about an expansion on increasing the productivity of the asset. If the productivity of the asset will increase as a result of that particular cost you have incurred, then we are trying to let you know that that should form part of the cost of an asset. Example is, for instance, you have a car and then you replace the car engine. Know that when you replace the car engine, it makes the car more efficient, and therefore the benefit you will derive from it will be enhanced in that regard. The next one is when you have an overhaul or a major inspection of an asset. A major inspection of an asset. So when you have an overhaul or a major inspection of an asset, there's a need for you to capitalize these ones as well. You need to capitalize them as well. So the cost associated with this will be capitalized, meaning you add it to the cost of item of PPE, and then that amount you are going to capitalize, you depreciate it over the time until the next overhaul, until the next inspection, until the next overhaul that you undertake. This another condition that results in subsequent expenditure. Another one is in the case whereby you're replacing a component of an asset that is made up of a number of components, like the engine I made mention of. It's a clear example of this one as well. If you are replacing a component of an asset that is made up of a number of numerous components, it's also part of this. Example we have here is an aircraft consisting of a body, engine, and an interior, all having different expected life. The replaced components will be derecognized. So the one that you're replacing with, the old one will be derecognized, and a new one should be added as part of the cost of that aircraft. So this is a typical example of subsequent expenditure. So remember these three main conditions whenever it comes to subsequent expenditure. Will it enhance the economic benefit of the asset? Does it relate to a major inspection? Is it about you replacing the major components of the asset? So these are things that result in subsequent expenditure. Key thing you need to note. Is there a question now? Please wait. Let me finish the explanation at least. Let's go to key thing you need to note under subsequent expenditure. We are saying that any other subsequent expenditure, apart from the ones that meet these three, if there is anything that falls outside the brackets, any other subsequent expenditure, you need to recognize it in a statement of profit or loss. You need to recognize it in a statement of profit or loss. So, for instance, general repairs. People usually do normal repairs and maintenance. So, those normal repairs and maintenance you do should be treated as an expense and not a subsequent expenditure in this case. So, this is about subsequent expenditure. Now, let me go back to the person who had a question. Who was that? Was it Isaac?
Hello, sir. Good evening.
Yeah, evening.
So regarding the third point, where you said replacing when it is replaced when you replace a component of an asset that is made of different components, like the aircraft. I saw that they said it has different expected lives or different expected useful lives. Does it mean that if you are going to calculate depreciation for the asset, you have to calculate based on the component or what?
Uh,
I don't
exactly.
understand.
Exactly. You calculate it based on the component. Each of the components have their own useful life. So, although they are all coming together to give you the cost for the depreciation, you have to calculate it separately because the useful life for them is separate.
So if you are going to determine the value of the assets, you have to calculate the depreciation for the various components, then subtract, then sum the remaining to get a total value of the assets of the
Exactly.
asset.
Exactly.
Okay. Thank you.
Okay, so let's look at a simple question on subsequent expenditure here. Can we get a reader? Let's go ahead.
Okay, sir, please. I'd like to ask whether the
Daniel,
um
can you wait? Can you wait? Let's finish the question, please. Let's finish the
uh,
question, then we come back.
okay.
So I thought you are coming to read for us, so by the way. So let's finish the question, then I'll come back to you. So if
Okay, so I'm reading.
okay, go ahead.
Daniel, the class is
I'm
recorded.
reading.
Daniel, the class is recorded, okay? So if you were coming to ask about the recording, the class is recorded.
Okay, go
Okay,
ahead.
sir.
Okay, so I'm reading. Question. A piece of machinery has annual service costing $10,000. During the most recent service, it was decided to replace part of the engineering, meaning it will work faster and produce more units of products per hour. The cost of the replacement part is $20,000. Would this expenditure be treated as asset or expense item? Thank you.
You're welcome. So let's check the two amounts there. We have two amounts. We have annual service costing $10,000, and then we have the cost of replacing a part, which is $20,000. In each case, which one are we going to include as part of the item of PP as cost, and which one are we going to expense? Or are we going to include all of them as part of the assets value? Or are we going to exclude all of them and treat them as expense? Yeah, Helen, go ahead. Yeah, Helen, your hand is up. Go ahead.
So I said then $10,000, that's the annual service cost, is an expense. So expenses to the P&L, and the $20,000 is the cost of replacement. So add it to the asset
Why?
because it is a significant part of the asset that has been replaced, which will enhance faster work and produce more units of the product per hour.
Okay, so per your explanation, it means that it's going to enhance the economic benefits, right? And also, it is replacing the major components from the conditions we read, right? Okay, thank you very much. Isaac, your hand was up as well. Do you have anything to add? Yeah, go ahead. Isaac, go ahead. You're muted.
Okay, sorry. So I was going to say the same thing that Madam just said. So I was going to say you would capitalize the 20,000 and then you expense the 10,000
Okay,
with the same reason she gives.
okay. Thank you very much. So as you rightly said, the 10,000 here will be expense and the 20,000 here will be capitalized. 10,000 expense because it's an annual service cost. Annual, meaning something you do on regular basis. Repairs you do on regular basis. Maintenance you do on regular basis. So that will be expense. But for the 20,000, as they rightly said here, it would enhance productivity. So meaning that the economic benefits will be enhanced, productivity will be enhanced, and that will be capitalized as part of the item of PPA. Yeah, Daniel, go ahead.
Thank you, sir, for the opportunity. And please, the question I want to ask is in relation to the the third point in relation to the subsequent expenditure.
Uh-huh.
Yeah, the example you made with regard to the aircraft, I want to know whether since we are treating PPE, would they affect building too, since building happen to be a property? Since
Exactly.
when we have an
So
okay, okay,
building will be affected. So in a case whereby building there is an extension of a building, so that relates to condition one.
okay,
Remember under
okay.
condition one,
Say about
we spoke about expansion. So you know a building can expand a building, right?
yes, please.
So in the case whereby there's an expansion, exactly, a building will be affected in that regard.
Yeah, but my question actually is that you see, when you mentioned that in calculating the depreciation with regard to the aircraft, all the components that formed or that come together to become an aircraft to be treated separately.
Exactly.
Please, are you listening?
Yeah.
So with a building, since you have different components making a building, would you also calculate depreciation for building separately, like looking at the components that form the building separately, please?
If you pick building as one, building doesn't have several components unless I'm understanding you as building and then a fence. Is that what you said? Building and a fence. If I'm getting you, like the other question we solved, like the PSA question we were solving, it was a building and then it was having a fence. So now in we check in that question, the useful life for both was different. If that's what you're saying, then I get you. But a building is just one structure. It's not having several components like an aircraft. Several distinct components like an aircraft.
Okay, sir. Okay, okay, sir.
Okay. Is there any other question? So we are done with subsequent expenditure. We can proceed, right? Okay, that's good. So we'll move on to subsequent measurement itself. Subsequent measurement. That means getting to the end of the reporting period. What do you do when you have an item of PPE? So we have two methods you can apply depending on the question and what the organization also uses. We have the cost model and then we have the revaluation model. So these are the two models we have, the cost model and then the revaluation model. Now with the cost model, it's what most of us are accustomed to. So with the cost model is whereby you pick the cost of the asset, you depreciate it. But over here, we target, instead of net book value, which we refer to it as carrying amount. So under the cost model, you need to ascertain the carrying amount, which you are going to show in your statement of financial position. And then you need to also calculate your depreciation, which you are going to show in your profit or loss. So how do you get carrying amount? To get carrying amount, you pick the cost of the asset, you less accumulated depreciation, and then you less impairment, if any. You less impairment, if any. We'll look at impairment in a separate standard, so I won't talk much about that. So you pick the cost of the asset, then you less accumulated depreciation. Bear in mind, accumulated here means summation of your depreciation. So if you're in year two, meaning you add year one depreciation to that of year two to get the accumulated depreciation for year two. If you are year four, you add from year one through to year four to get the accumulated depreciation. Now the issue is, I'm sure most of us know about numerous depreciation methods, right? What are some of the depreciation methods you have been exposed to? Daniel, your hand is still up. Or is it from the old one?
Reducing balance method, sir.
Reducing balance. Okay. But Daniel, okay, yeah, reducing balance method. What else? Isaac, go ahead.
Straight line method.
Straight line method. Okay. What else? So you're speaking about reducing balance, you're speaking about straight line. Which other method do we know? Yeah, Christian.
Some of here they get method.
Some of years they get method. Mm-hmm. Which other one do we know as well? Okay, so you have mentioned straight line, you have mentioned reducing balance, you have mentioned sum of years decades. Okay, hand is up, Isaac. Isaac, go ahead.
Is it units of production or something?
Yeah, so production method using the unit approach. So production method using the unit approach. Okay, that's fine. Helen, can go ahead.
So the depletion method.
Depletion, same as reducing balance. Or
Okay.
are you talking of depletion of natural resources? If I get you.
Yes.
Depletion of natural resources. Oh, okay.
Then we have sinking fund method.
Okay, sinking fund method. That's fine. So let's come to the standard. The standard only recognizes three approaches. It only recognizes straight line, reducing balance, and then machine approach. So straight line method, which you already know already, is applied when you're calculating for your depreciation. Reducing balance method, which is also called the diminishing method, and then the production method using machine hours. So the production method, we have two approaches. So someone mentioned the unit approach. That's based on the number of units you have produced. We also have the machine hour approach. These are the three methods that are used in the standard. So bear in mind, these are the three methods. In exams, you need to concern yourself about these three methods whenever it comes to the cost model when you're calculating for your depreciation. So far, all of them has been examined before, but it's been a long time they examined the machine hour. It's been a long time, but most of the time it's just a straight line and reducing balance. The machine hour has been examined, but it's been in the past. In the past, so these are the methods of depreciation you need to be conversant with. So that's all I'll talk about over here. So under the cost model, remember we need to account for depreciation, which will go to profit or loss for FR. For my PSA students, statement of financial performance. So statement of financial performance, you take it there. So statement of financial performance. But for the carrying amount of the assets, you are going to report it in your statement of financial position. You report that one in your statement of financial position. So this is about the cost model. The cost model. Basically about the cost model. The other notes are for additional reading. Like for instance, over here, it's just a reiterating of the points we made mention of. That if an asset is made up of numerous components, they are made up of separate parts, and then they have their unique useful life. Make sure you depreciate them separately as well. So these ones, we have spoken about them already. We'll move straight into the revaluation model. Move straight into the revaluation model. So the first one is, if you are using a revaluation model, what are the conditions for its compliance? So we first have to know the conditions for its compliance. We have two major conditions. Number one, the revaluation must subsequently be made with sufficient regularity. We don't use the revaluation model just once, maybe in the asset useful life, and then you're done. You stop over there. Once you adopt the revaluation model, you have to do it regularly. So maybe every 6 months, every 1 year, depending on the company's policy. If you want to go by the revaluation approach, there should be some form of regularity in it. The reason being that here, with the revaluation approach, deals with the fair value, and the fair value should mostly comply with what is on the ground. So you don't want to see any difference or a huge margin when it comes to the fair value reporting in the books. So with a revaluation model, Once you choose it, it should be regular in its use. The next thing is that where an item of PP is revalued, the entire class of that asset to which that asset belongs to should be revalued. So if you're revaluing property, if you revalue just one, make sure that the other classes of it all should be revalued. So revaluation, you don't do it just for one item. If there are a list of items in a particular group or class, make sure you do them. So if you have property, groups of property, you revalue just one. You can't just do just for one. You have to do for the others as well. So these are, in terms of theory, conditions in which we apply the revaluation. Conditions must be complied whenever you use the revaluation model. The next thing is that under revaluation model, you need to ascertain what we call revaluation gain or loss. You need to get what we call revaluation gain or loss. Before we go into the calculation, first we need to know the accounting treatment for each case. If you are going by revaluation gain, what will be the accounting treatment? If you are going by revaluation loss, what will be the accounting treatment? So revaluation gain here will basically mean that your asset value has increased. So if the asset value has increased and it is for the first time, keyword, it is for the first time, the treatment should be done in your statement of other comprehensive income. So you should go into your statement of other comprehensive income. But if it is not the first time, and then previously you had a revaluation loss, then there is a need for you to record it in your statement of profit or loss or statement of financial performance up to the measure of amount for that revaluation loss or revaluation decrease as said over here. Let me give an example. So we have an asset here. Let me just call it, maybe you have a property. In year one, you had a revaluation loss. A revaluation loss, as you know, the default for revaluation loss will go to profit. That's the default treatment, please. If it's a revaluation gain, the default will go to other comprehensive income. So the default for revaluation loss, year one, you had a revaluation loss, let's say 10,000. And it came to year two. And in year two, you had a revaluation gain this time around of, let's say, 15,000. How should the accounting treatment be done? When you come to year two, you first have to send a measure of the loss that happened in year one. So a statement of profit or loss, or if for the PSC student, that will be statement of financial performance. So in statement of profit or loss in year two, so in this year, in year two, let me just indicate it here. In year two, you need to send a measure of the loss, a measure of the gain to come and cancel the loss that happened last year. So you bring revaluation gain here. The issue is how much of the revaluation gain should you bring? You should bring up to the amount of money. If the amount of money is up to or exceeds. So if you check year one, you realize that the revaluation loss was 10,000. In year two, we have a revaluation gain of 15,000. What do you bring here? You bring 10,000 of the revaluation gain to profit or loss. Then the outstanding, you take it to the default. So the default for revaluation gain, as you know, goes to statement of other comprehensive income. You take the default to statement of other comprehensive income as revaluation gain, 5,000. This is what the explanation means. Let me bring another case as well. So let me this case 1, let me bring another case 2. Case 2 is here we have a revaluation loss of, let me maintain the same figure, 10,000, and year 2 we had a revaluation loss of 9,000. In year 2, how are you going to go about the treatment? Same approach here. In year 2, you prepare statement of profit or loss. And the reason you're preparing a statement of profit or loss is because year 1, you were having a loss there. So you have to send a measure of the gain to go and cancel what you did in the previous year. Yeah, what will be the figure? The loss that happened in year 1 was 10,000. But your revaluation gain was only 9,000. So how much of it are you going to send? You send the whole 9,000 there. Why are you sending the whole 9,000 here? Because the loss was 10,000. You can only take care for or take care of only 9,000 of it. Do we understand, please?
Sir, please kindly go over again.
Sir, please, can you go over again?
Okay, let's start from here. So first thing first, the default. Let's look at the default. If you get revaluation gain, what is the default? Revaluation gain should go to statements of other comprehensive income. That's the default. Revaluation loss. If you get a decrease in your carrying amount, which is a revaluation loss, it should go to profit or loss. So we should first know the defaults. Do we all know the defaults now?
Yes, please.
And now
Sir,
let's go back to yeah, defaults are coming. Let's go back to the revaluation gain. If you have a revaluation gain now, and it's not the first time that you're having this revaluation gain, and then in the previous year you had a revaluation loss, how is the treatment done? So if you have a revaluation gain, you know by default it goes to other comprehensive income. But if in the previous year you were having a revaluation loss, in that case, you need to send the revaluation gain now to profit or loss. And the reason you're sending to profit or loss is that you want to reverse the old revaluation loss you recorded in profit or loss. And here we are saying that when you do that, make sure the value is of the same value. So first case that I did here was that we should assume that in year 1 we had a revaluation loss. We incurred a revaluation loss of 10,000. And then in year 2 we rather had a revaluation gain of 15,000. In year 2, how should the treatment be done? Ideally, the revaluation gain that we have here in year 2 should have been sent, everything should have been sent to other comprehensive income. But we can't do that. Why? Because in year 1 we had a revaluation loss. So in that case, what do we do? In that case, you need to check the loss you had. The loss, you realize you had 10,000. So the revaluation gain that we have, we are going to record it first in statements of profit or loss or statements of financial performance up to the measure of loss that we had in year 1. So the revaluation gain here, you can clearly see that we sent 10,000 here, we brought 10,000 here because we want to reverse what was done in year 1. Then the remainder, you now take it to the default. And what's the default? The default is that it must go to statements of what? Other comprehensive income as revaluation gain. Normally 5,000. And then the second scenario I created was that we still have a loss of 10,000, but this time around in year 2, we had a gain of 9,000. How would the treatment be done? If you had a gain of 9,000, in statement of profit or loss or financial performance, you take that revaluation gain to statement of profit or loss. And the standard always is up to the measure of the amount. You check your loss, the loss was 10,000. But again, you rather had 9,000, which was lesser than the loss you incurred. So what do? You take all the loss, all the gain that you have. That's what you have. You take all the gain to where? To statements of profit or loss. 9,000 there. And then nothing will come to statements of other comprehensive income, because even the amount 9,000 was not enough to cover the loss. Do you understand?
Yes, please.
Isaac, your hand is up. Go ahead.
Okay, sir. Okay, so when you are going to write off the previous loss, are you going to do it in the current statement of profit or loss, or you are going to send it to retain earnings?
You are going to
Let's
send
say
it
that
to
for this.
the current statements. The current statements.
Okay, so last year I made a loss of 10,000. This year I made a revaluation surplus of 9,000.
Hey, please,
And so if
Isaac,
I'm going
Isaac, wait. Before you proceed, the loss they are mentioning here is revaluation loss, not profit
to
loss.
loss, yes, yes, yes. So
Not
I made a revaluation loss of 10,000. That was debited to the P&L. And this year I made a profit. Sorry, a revaluation gain. That gain I'm supposed to use it to write off the previous loss. So if I'm treating it, should I treat it in the retained earnings so that to write off the previous loss in the retained, I mean last year's loss, or I should treat it in the current year's P&L?
we do it in the current year.
Okay, sir.
Yeah, Jerry, go ahead.
Okay, so in looking at the case two, the revaluation was 10,000. We had a revaluation of 9,000. So there will be a difference of 1,000. That 1,000, are we going to carry it forward?
Exactly. So
Oh,
if
okay.
in year
Thank you.
three, you get another revaluation gain, you first have to send 1,000 to statement of profit or loss, and then the remainder will now go to OCI.
Thank you.
Okay. For those who maybe are not getting it, we'll solve questions. Sure, from there you get more understanding of that. Let me go to the revaluation loss scenario too. So revaluation loss, as you have a decrease in your carrying amount. A transaction will be recorded where in your statement of profit or for the default or statement of financial performance for your default. But in the case whereby you are having a previous revaluation gain, just like we did for the other one, if you have a previous revaluation gain, that revaluation loss you had, you will take it to under comprehensive income to go and reduce the previous revaluation gain or surplus you recorded. So let me use an example over here too again. So this is for the revaluation aspect, revaluation loss case aspect. So let me do another one, case one. Let me do this one, case A and case B. So case A is in the case that year one, we had a revaluation gain of, let's say, 50,000. In year two, we had a revaluation loss of, let's say, 65,000. How will you go about it? Yeah, ideally, the revaluation loss in year two should have been sent to profit or loss. But because you have a previous revaluation gain, you first take the revaluation loss to statement of other comprehensive income. You first take it there. How much of it should you take? You should take it up to the amount of gain you recorded in the previous year. So we ask ourselves, what was the gain recorded in the previous year? It was 50,000. How much is the loss we recorded this year as revaluation? 65,000. How much can we send to statement of other comprehensive income? Since the amount is more than what we recorded in year one, we need to send to the measure of what we recorded in year one, which is 50,000. So when it comes to statement of other comprehensive, we write here revaluation loss. Then you bring there what? 50,000. Yeah, to be negative, you bring your accounting negative. Let me change this. You bring it there, the loss, 50,000 there. Then the rest will come to statement of profit or loss. Then you bring your revaluation loss there for the remainder. The remainder here will be 55,000 minus 50,000. That will give us 15,000, right? You bring the rest there. That's how you go about it. Then we can have another case B, whereby this time around I'll maintain the revaluation gain here as 50,000, but the loss, let's say we had a loss of 35,000 instead. The rule still persists. First in year 2 you had a loss, and then in previous you had a gain. First take it to OCI, and then set the measure of loss up to the value of the gain you had in year 1. So yeah, we'll prepare the statement of other comprehensive income as usual. But the question is, how much should you send here? You just go to year 1 and ask yourself, how much of the gain was there in year 1? It was 50,000. How much of the loss can you send to to cover for that loss? You send all of them because the amount of money is lesser than the gain. So you send all of them, which is a 35,000. So record 35,000 here in that regard. Did we get it? Think. Yeah, Isa, go ahead.
Yes, sir. Can you hear me, sir?
I can hear you. Go ahead.
Yeah, please, I'll be glad if you could explain this particular question. I just joined, but
Okay,
if you
we'll solve a
explain this
question.
question for me once again, I'll be glad.
Yeah, so we'll solve a
We
question
will
before I
solve a
explain it.
question, right?
Yeah. Yeah,
Okay, sir.
Jimmy.
Thank
Go
you
ahead.
very much.
You're welcome.
Okay. So, sir, the difference between the 50 and the 35, are we maintaining it in the statement of other comprehensive income?
Come again.
The difference, you know, the case B, the revaluation gain is 50,000 and
For
the
year
loss is
one.
35. For year one, sorry, is 50,000. And year two is 35.
For the
And
loss. Uh-huh.
yeah, for the loss, so the difference for us to recognize, we have to take out the 35 against the one we initially recorded in the statement of other comprehensive income.
Uh-huh.
My question is the difference between the 35, the 50 and the 35, are we maintaining in the statement of other comprehensive income, or we are moving it into statement of performance?
You're not going to do anything with the difference. Unless something happened in year 3.
But we'll maintain it in the statement of other comprehensive income.
The 35,000, yes.
That will be 15,000. The 15,000 will maintain it in the other comprehensive income for the
Which
third
which
year.
which, which 15,000 are you referring to? Are you referring to case B?
AKB, you know, the revaluation gain year one is 50,000. Year two, the revaluation loss, which is 35,000.
Okay, yeah, more young, and I will.
Please, are you following?
Yeah, I'm following. Go ahead.
And I'm saying that in treating the loss, we have to record it against the initial one that we recorded in, which is a revaluation gain in year one. And there will be a difference that will be 15,000. And I'm asking, going into the year three, Are we maintaining that 15,000 in the statement of other comprehensive income?
Yeah, so you maintain it if there is another loss again
No, okay.
up to that measure
Thank
of value in year 3.
okay, thank you.
Okay. Let's go straight into questions. Yes, sir.
Sir, please wanted to ask for the revaluation loss. If we don't have a previous revaluation gain, we have to we should keep it in the P&L. Should we keep it in the P&L?
Exactly, yes.
Thank you.
You're welcome. Okay, let's go to our question now. Question 1. I'll read that. Please read for us.
Can I read?
Okay, you can go ahead.
Okay. On 1st January 2017, the fair value of 𝐿𝐺𝐵 Limited properties was 400,000 with a remaining life of 20 years. The company's policy is to revalue its property at the each year end at 31st December 2017. The property was valued at 344,000. The balance on the revaluation surplus at 1st January 2017 was 80,000, which relate to entirely to the property. 𝐿𝐺𝐵 does not make transfers to realize profits in respect of asset depreciation. Required: A. Prepare extra of 𝐿𝐺𝐵 financial statement for the year ended 31st December 2017, reflecting the above information. B. State how the accounting will be different in the opening revaluation surplus did not exist. If the opening revaluation surplus did not exist.
Okay, thank you very much. Now, this is the question we have. How do we go about it? Number one, as usual, always starts from the date. Always check the date in the question and always start from the beginning. So let's start from question 1. So in question 1, we were told that the fair value of 𝐿𝐺𝐵's property was 400,000, and they have given us the remaining useful life for it is 20 years. Before I even dive into this, let me talk a little. I think I didn't talk about the calculation aspect of revaluation. Before I go into the question, let me just talk about it. So how do we get revaluation gain or loss? I should have spoken about that before we started the calculation. So revaluation gain or loss, how do you get that? To get revaluation gain or loss, you pick the revalued amount, then you less the current amount of the assets. So that's the first thing you need to note. To get revaluation gain or loss, pick the revalued amount of the assets and then less the current amount. If you get positive, then it's a revaluation gain. If you get negative, then it's a revaluation loss. So bear in mind, if you get a positive answer, it's a revaluation gain. If you get a negative answer, it's a revaluation loss. Now, after you have gotten your revaluation gain or loss, what do you do subsequently? So we say subsequently apply the revaluation approach. So what do you do subsequently? So subsequently, we need to account for what we call subsequent depreciation. And how do you calculate for subsequent depreciation? So if it's just a straight line method, usually you pick the revalued assets, the amount of the revalued amount of your assets, then you will less if there is a revised scrap value. Always checking the question if there's a revised scrap value. Most of the times you may not get that. Then you divide by remaining useful life. You divide by your remaining useful life. So first, the numerator will be your revalued amount minus the revised scrap value. Then you divide by remaining useful life. That's how you get your subsequent depreciation. That's after revaluation. How do you get your depreciation? Take your revalued amount minus the revised scrap value divided by the remaining useful life. If it's the reducing balance method, usually they will give you a new percentage of depreciation to deal with. So that's that. Most of the time, the question will be straight line method. So you need to know this formula. Take the revalued amount less your revised scrap value, divide by the remaining useful life. Then when you're done, you need to get your carrying amount that you're going to report in your statement of financial position. So how do you get carrying amount? Just as we did at the cost model. Same approach. The only thing is that here, your value now is the revalued amount. The value of the asset is now going to be the revalued amount you have now. Then you subtract subsequent accumulated depreciation from it. You subtract your subsequent accumulated depreciation. So if it only happens once, then your subsequent depreciation will you just bring it there. But if it after subsequent depreciation, maybe you look at after 2 years, then you need to find the accumulated depreciation for that. And then you less impairments. Some call it subsequent impairments. That means after the revaluation, any impairment you have, you less it if any. As I said, we'll look at impairments in another discussion. So this is how you get your depreciation. You pick the revalued amount less the revised scrap value divided by remaining useful life. The carrying amount, how do you get that? You take the revised amount of the assets minus your subsequent depreciation minus your subsequent impairments. This is how you go about that. Now let's come back to our question 1. With question 1, we're given the fair value of the assets, the fair value of our property, as 400,000 at a particular date on 1st January 2020. Now we need to ask ourselves, when did the revaluation occur? So you have to check when the revaluation occurred. We're told that it's the policy of the company to revalue its property at the year end, at 31st December 2017. The property was valued at this. So that means that the revaluation occurred 31st December 2017. So on 31st December 2017, you need to ascertain the revaluation gain or revaluation loss on that date in which the revaluation occurred. How are we going to go about that? So you know the formula for that already, as I gave you. To get revaluation gain or revaluation loss, you pick the revalued amount and you less the carrying amount. So the issue here is that you have your revalued amount already as 344, but you have your carrying amount at 31st December 2017. No, you don't have your carrying amount. So what do? You have to first get your carrying amount at that date. What you have rather been given, you have been given your value as at 1st January 2017. So we need to now get our carrying amount from this value. How are we going to do that? So the value we have as at 1st January 2017 is 400,000. Now the question you ask yourself is, what's the period till the next revaluation? What's the period from the question to the next revaluation? The revaluation happened at 31st December 2017. So what's the period from the value that we have our asset on 1st January 2017 to the revaluation?
1 year.
1 year. That means that we need to calculate for depreciation for 1 year. We need to calculate for depreciation up to the date in which we revalued our assets so that we can get a recurring amount of the assets. So here we are going to calculate for depreciation. How are you going to calculate for depreciation? As usual, you bring the cost of the asset, which is 400,000. You check if there is a scrap value. Are we given a scrap value in this question? Are we given a scrap value?
No, please.
No, so we're not given a scrap value. So we just go with that. So you just bring the value of the asset and you divide by the useful life. The useful life, we were told that it was left with 20 years at that day. So we are going to use 20 years. So let's divide that 400,000 divided by 20 years. What are you going to get?
20,000.
We get 20,000. Then we subtract to give us the carrying amount. The carrying amount as at that date. So carrying amount as at 31st December 2017. What are we getting?
380,000.
380,000. Now, when we pick this 380,000, we compare with our revalued amount, which was at that same date as well, which was 31st December 2017. We check what is the revalued amount. It was 344. So it was 344,000. We compare. So you know the formula, so I gave you the formula. There's a revalued amount minus the carrying amount. So you compare and check whether you're going to get a revaluation gain or a revaluation loss.
A revaluation.
A revaluation loss, right? A revaluation loss. What's the value of a revaluation loss?
36,000.
36,000. Come on, give me a
It's
minute.
not 44.
So that will give us 36,000. Okay. That will give us 36,000. So that's a loss, right? Revaluation loss, right? So bring the negative, showing that it's a loss. Accounting negative. So this will be our revaluation. Yes. You all get how we had a revaluation loss before we proceed.
Yes, sir.
Okay.
Okay. Then we proceed with the question. The question went on to say that the balance on revaluation surplus. Now, when they say balance on revaluation surplus, they're trying to tell you that you have a previous revaluation gain or revaluation surplus. You have a previous revaluation gain. On 1st January 2017, it was 80,000. And they said it related entirely to your property. So this is telling you, or this will help you for your treatment, your accounting treatment. It clearly means that in previous year you had a revaluation gain. But in this question, we had a revaluation what? It was at 31st December 2017, we had a revaluation loss. But on 1st January 2017, there is a balance on your revaluation surplus. So in the accounting treatment, what are we going to do? How are we going to treat it? In accounting treatment, how are we going to go about it? Yeah, Helen, go ahead.
Again,
Why?
the previous, we have revaluation gain.
Yes.
The revaluation gain was 80,000, and we have a loss of 36,000. So the instead of we taking the 36,000 to the profit and loss, we'll take 36,000 to the OCI to offset the to the extent of the previous gain that we have at the OCI.
So yeah, we are going to send the whole thing or part of it.
The whole thing, sir.
We'll send the whole thing. Okay, that's good. So yeah, we'll prepare the statement. So this for A. Remember the question was in A and B. Then bring the name of the entity. It was Ejapa Limited. So yeah, we have the financial statement here. So we prepare the statement for statement of profit or loss for the year ended. The question asks us to prepare for 31st December 2017. 31st December 2017. You bring your currency sign, Ghana cedi. What do we report here? First and foremost, don't forget your depreciation. You have to report depreciation. Right, so you bring your depreciation here, and depreciation is an expense, so you need to show it as negative over here, accounting negative over here. So you bring your depreciation figure here. Then the next one, we are going to bring what? The revaluation loss we had here. Ideally, if we're not having a previous revaluation gain, we'll have brought the revaluation loss in POL. But because we have a previous revaluation gain, as Helen rightly said, we are going to turn a statement of other comprehensive income. So statement of OCI for the year ended 31st December 2017. Then here we are going to bring our revaluation loss of 36,000. Then we are done with the A aspect of the question. So this is for the A aspect of the question. Now the B aspect of the question here is saying that state how the accounting will be different if the opening revaluation surplus did not exist. So if we are not having an opening revaluation surplus, what will have been the treatment? So if there was no previous revaluation surplus, the loss you had, where would you have sent it? You have sent it to where? POL.
So
Yeah.
P&L.
Yeah, I think I left one statement out, right? I didn't bring statement of financial position. Let me do that one before we move on to the theme. So statements of financial position. Let me bring that statement of financial position as at 31st December 2017. Extract. Okay. So here we have to do statement of financial position. Yeah, what value are we going to bring as our statement of financial position for our assets? So for the PPE value,
344,000.
The revaluation amount.
yeah, the revaluation amount. Since the asset was revalued, the new value is now the revalued amount, which is the 344. So we bring the 344 here. that case. And then you have to also bring the heading. The PPE will be under non-current assets. Since it's an extract, you need to bring the heading that it will fall under. Okay, let's come back to the B as we were before. So the B here, I'm repeating it again, it says that state how the accounting will be different if the opening revaluation surplus did not exist. So if our opening revaluation surplus did not exist, what we'll have normally done is that the loss that we had, we'll have sent it to profit or loss. That's all. So when we come to B, what we have to just do is to bring the same statement here. The only thing is that here we're now going to bring our revaluation surplus here. We'll bring the revaluation surplus here. A depreciation figure. Yeah, so you just bring the revaluation loss figure there and then the depreciation figure there. Then we just prepare our statement of financial position. Same value will be here. So this will be the difference. So if it was we had the previous revaluation surplus there, the revaluation loss here will come to statement of other comprehensive income. So over here to just be to come under statement of other items. Okay, this one is that. Okay, so that's that. The value of the asset, let me bring the actual value here. Supposed to be 344. So if you have questions, I'll invite them. If there are questions on what we have done, I'll invite them. Yeah, go ahead.
Yeah,
Esther.
please, sir, in the presentation, um, what we've done, yes, I know it to be correct, but I want to ask, why didn't you show like the difference in the extract when we were recording the revaluation loss? The difference, like 8,000, and then do the deduction of the 36,000, and then get the final answer in the extract. Or maybe do a bracket. And it will-
I'm confused. Difference. The difference I referring to. Come again.
You see, the question was stated that the balance, opening balance of the OCI was 80,000. Separate
Okay.
digger.
Okay, I get you now. The opening balance of the revaluation surplus. Okay. Okay. So if you want to show the balance, revaluation surplus is an equity item in property, plant, and equipment. That in statement of financial position. You know that, right? So if you want to show the balance, you can only show the balance here and equity. You bring your revaluation surplus. Then here you bring the balance here, which is 80,000 here. Then you less the loss. The loss was 36,000. Then the difference you can come here. So what would the difference be?
44,000.
44,000. So if you want to show the difference on the revaluation surplus, you can only show it in equity. There's another statement, but I don't want to mention it now. When we get there, we'll do that one. So there's another statement you can show it as well. But in simple terms, just show it as equity, the difference. You can show the difference here on the equity. Are you fine, Esther?
Yes, sir. Thank you.
You're welcome. Any other question? Okay, there's no question. Esther, your hand is still up. Oh. You have another question? Okay.
No, please.
Okay. Let's move to the next question. Question 2. So Arita, please go to question 2 for us.
Okay. Everest Limited evaluate land and building at the start of 2018 to 4 million 4 million Ghana cedis, 1,600,000 for 1,600,000 for land. The property cost of 2,400,000 for the land. 10 years prior to the revaluation, the total expected useful life of 50 years is unchanged. The company's policy is to make an annual transfer of realized amount to retained earnings. Require show the effect of the above on the financial statement for the year ended 31st December 2018.
Thank you very much. So how do we go about this? Now there is a difference between this question and then this question. The question 1 here, you realize the last sentence. Say a JAPA does not make transfer to realize profit in respect of excess depreciation. So that's why in question 1, I didn't talk about anything excess depreciation. But question 2 here made a statement that the company's policy is to make an annual transfer of realized amount to retained earnings. Whenever you see these clauses, if they say does not, then you don't have any wahala. But once they say you are supposed to make transfer of realized amount, then you need to account for what we call a concept we call excess depreciation. So what is excess depreciation? Number one thing you should know that excess depreciation only occurs when you have revaluation. So when you have either you're moving from cost to revaluation, you see of excess depreciation, or whenever you're doing revaluation, you see the concept of excess depreciation. Now, excess depreciation here, how do you go about it, or how do we get it? To get a value for excess depreciation, you basically pick your new depreciation after revaluation. So the depreciation after revaluation, usually tag it as new depreciation. Then you subtract your old depreciation. Your old depreciation is before revaluation. What was your depreciation figure? So before revaluation depreciation figure and after revaluation figure, you look for the difference. The difference is what we call excess depreciation. The next thing is, what is the accounting treatment? Now, excess depreciation, the accounting treatment for excess depreciation is that you are supposed to subtract this. Okay, I think I have to mention the statement that I spoke about. You have to account for this we call statement of changes in equity. Some of you might have heard of it. In public sector, that will be statement of net asset. So public sector students, that will be statement of net asset. And for FR students, that will be statement of changes in equity. So in your statement of changes in equity, you need to, so let me do an extract in that regard. You have a column for revaluation surplus. You have another column for retained earnings. So let me use this as a case. Let me bring Ghana cedi here, Ghana cedi here. Let's assume you have brought your opening balances. So opening balance, let me use XX to represent that. Now, how do you account for the excess depreciation? Now, the excess depreciation here, we always say the excess depreciation came about as a result of the revaluation. So with the excess depreciation, to account for it, you will less it from your revaluation surplus. You less it from revaluation surplus. Then you add it to your revaluation gain. So you less from revaluation surplus, you add to your revaluation gain. So that's the treatment. Less from revaluation surplus, add to less from revaluation surplus, add to your retained earnings. That's what I mean. Less from revaluation surplus, add to your retained earnings. Then you get your closing balance in that respect. Balance brought down. So these are additional treatments you do if the question asks. Remember, if the question asks before you do it. If the question doesn't ask, don't bother yourself to do it. So if the question asks that you should account for excess depreciation, you make transfer in respect of realized profit, then you account for excess depreciation. So I'm repeating this again. How do you get excess depreciation? You pick a new depreciation. The new depreciation here means after the revaluation, what was your depreciation figure? Then less old depreciation. Old depreciation is here is the before the revaluation. What was the depreciation figure? These two amounts, look for the difference. Now the difference you have gotten, we assume that this difference is because of your revaluation surplus. So go and subtract it from your revaluation surplus. So you go to your statement of changes in equity or statement of net assets. You subtract it from revaluation surplus here, and then you add it to revaluation retained earnings in this respect. Two hands are up. David, your hand went up first. Go ahead. David, go ahead. Okay, David is not talking. Let's go to Isaac.
Hello.
Yeah, David, go ahead.
Uh-huh. I wanted to find out the depreciation we're talking about. Is it the accumulated depreciation or charge
No,
for the year?
no, the regular
The differences you are talking, the new
the
and then the
charge
old.
exactly. The charge for the period. So the charge before before the revaluation, the charge after the revaluation, the depreciation charge before the revaluation, the depreciation charge. David, are you fine?
Then getting the old depreciation for the particular year is going to also be another calculation.
The question will give you information on that. So don't worry, the
Okay.
question will give you information on that. Yeah,
All
Isaac.
right. All right.
Isaac, go ahead.
Okay. Say, so per my understanding, the revaluation can be done at the beginning of the year, at the middle of the year, or at the end of the year. When
Exactly.
it's done at the beginning of the when it's done at the beginning of the year, it means that for the that there's no depreciation charge for the year so far. And so in that case, that means that there will not be any new and old depreciation or
No, there will be last year's depreciation will be the old,
become the old one.
and then this year's own becomes the new.
I was thinking because it's last year and you have closed chapters on last year, you don't have to go back there again.
Yeah, you still
Okay.
account for excess depreciation because the excess depreciation came because of your revaluation. If you didn't revalue your
Mm,
assets, you don't get anything like excess depreciation.
okay.
Yeah.
Then what if it's done at the end of the year?
End of the
Will there
year.
be any yes, the revaluation is done at the end of the year. Will there be any new depreciation again? Because the
No,
year has ended.
there won't be any new depreciation. For the new
Ah, okay.
depreciation
So
should be
in that case,
after the new depreciation should be after revaluation. So if it's at the end of the
okay.
year, there'll be nothing like excess depreciation. But if it's at the beginning,
Ah, okay.
if it's at the middle, if it's at any period before the end, then yes. But if it's exactly at the end, then no.
Ah, okay. Thank you, sir.
You're welcome. Okay, let's go back to our question itself. Yes, so let's go back to our question itself. That's the first thing. This question was different. Number two, we have land and building. One thing you should know is that land, we don't depreciate land. So whenever you see land, we don't depreciate land. That is why the question, usually when you have a question, they separate the land from the building. If they don't separate land and building, that's what they call as property together. That way, you just go by. But in the case whereby they separate land and building for it, bear in mind that land, we don't depreciate land. But the building will be depreciated, so you account for them separately in that regard. So let's go ahead for this question. So we have land and building, and we are told that the value at the start of 2018 was 4 million. And we're told that land is 1.6. So if land is 1.6 million, what will be the value for building? Will be what? 3.4. That's correct. That will be 3.4. So if you want the building,
Is it
the
2.4? 2.4.
It's 2.4 instead.
2.4 rather. Yeah, 2.4. Okay. Thank you for the correction. That will be 2.4. Okay. Then we were told that yeah, the property cost was also 3 million and the land was 400,000. So if the land is 400,000, what will be the building value?
1.6.
What will be the building value?
1.6 million.
1.6 million. That's correct. So as we said, in this question, we need to separate it. So as we said, in this question, we need to separate them. So we'll do the land separately, then we'll do the building separately. So land we don't depreciate. So the only thing you have to worry your head about, or please mute yourself if you're not speaking. Mute. So the land, once we are not depreciating the land, the only thing we have to worry ourselves is the revaluation gain or loss. So yeah, we just account for revaluation gain or loss. So we have to just pick the revalued amount, and the land, the revalued amount here was 1.6 million. So we just pick that one. So the revaluation gain or loss will be 1.6 million. So you just pick out 1.6 million there. And then yeah, the carrying amount of the land will be the same as the cost because we don't depreciate. So we just pick the cost, which is 400,000. Because land we don't depreciate, the carrying amount is still the cost. So we less, and then we check whether you're going to get a revaluation gain or revaluation loss. Are you going to get a gain or a loss?
Again,
Yes, gain.
Again,
What's going to be our value of our gain?
1.2 million.
1.2 million.
1.2.
That's correct. 1.2 million. Then we come to the building. We do that for the building as well. But for the building, remember that one you need to what? Find the carrying amount. So you find the carrying amount. The first thing we need to bring is the cost. We are giving a cost at a particular date. So we bring the cost. What is the cost here? That was what we said. It's going to be 2 million minus what? 400,000, right?
2,400, yes.
Yeah, so let me show the workings here for revision purposes for those who want to revise. So the building value will be what?
1.6 million.
1.6 million. And here the date is very important for purposes of depreciation. So let me bring the date here. What was the date that the cost was on?
first January 2018.
It's 1st January of which year?
2018.
Are you sure? Read the question
So,
again.
is that 10 years, 10 years prior?
Yes, 10 years proud. We all know proud. Proud
Um,
means before.
Before.
So if they say 10 years before, what would that be?
2008.
2008.
No, wait, I'm counting my hands to be sure. Are you sure it's 2008? Count your hands and be sure.
10 years.
Are you sure it's 2008?
2007.
Yes, sir.
If you want to use 2007, third December.
So look at the question. Oh, that's what I'm saying. I don't expect this from you. I want you to come up with it yourself. So look at the question. The revaluation occurred at where? At the start of 2018. That is 1st January 2018, right? So if you are saying 10 years prior, when would that be?
2007.
So 2007, beginning or end?
And 3rd December.
End. So if you're using 2007, then to be 31st December 2007. But if you're using 2008, then to be 1st January 2008. Do we get it? So
Yes,
it's going
please.
to be 1st January 2008. And what's the next thing we do? The next thing we do is to get our accumulated depreciation.
Appreciation.
So how are we going to get our accumulated depreciation? We bring the cost of the asset. We check if we have scrap value. Do you have scrap value for our building?
Please, no.
No. So we
No,
divide by
please.
50 years. We divide by 50 years, right? Then multiply by
Yes, please.
the number of years you are looking at. This valuation occurred in 2018 start. So we are going to do this one for 10 years, right? 10 years
Yes,
prior.
please.
The
Yes, sir.
accumulated depreciation for 10 years. If we do that, what are we going to get?
400,000.
400,000. Then we subtract. So it's going to be 1.6 minus the 400,000. This will be the carrying amount. What will be the date for this carrying amount? The 31st December 2017, or
Yes. Right.
yeah, that will be 31st December 2017. And when we come to 2018,
For the
1st January,
depreciation, I had
depreciation you had what?
320,000.
Three.
320,000.
Okay, please let's check. Is the depreciation correct?
This is 320,000.
320 rather.
Yeah, the depreciation is 320,000.
Okay, that's fine. So these are carrying amounts, right? Then on 1st January 2017, that was when the revaluation occurred. And our current amounts, closing balance becomes opening balance. So it will be the same value here that we have here. Then we are going to bring the revalued amount at that same date. The revalued amount was on that same date, 1st January 2017. Oh,
2018.
2018, sorry, 2018. So what was the revalued amount? So we have to get that value as well. We're giving the whole land and building to be 4 million, and then the land was 1.6. So let's look for the value. So it's 4 million minus 1.6 million. What would that be?
2.4 million.
2.4 million. We compare and see whether we have a revaluation gain or revaluation loss. So let's check. Do you have a revaluation gain or a revaluation loss? Revaluation gain, because the revalued amount is greater. So we have a revaluation gain of this value. So this is our revaluation gain. But the statement is requesting that you prepare up to 31st December 2018. So we have to prepare up to the year end. Now, if it's up to the year end, this is where we are going to calculate for subsequent depreciation, right? For the value of our assets now, after revaluation, the value of our assets on 1st January 2018 will be what? Will be the revalued amount, right? Will be the revalued amount.
Yes, sir. Yes, sir.
So we need to get the value of our assets at the end of the financial period. That's what we call the subsequent depreciation. So we calculate for depreciation after revaluation. How do we do it? You bring the revalued amount, as we said. You check in the question if you have revised useful life. In this question, we didn't even have useful life, and then we are not having revised useful life. So we go away with that. Then we just divide it by the remaining useful life. So what is the remaining useful life? The total useful life is what?
49.
Total useful life is 50 years, right?
40. So then it's 40 years.
Total useful life is 50 years, right? And then we have child depreciation for how many years? You can see it here, 10 years, right?
Yes. Yes.
So remaining useful life will be what? 40.
40 years.
40 years.
Yes.
40 years.
So what are you going to get?
Mm, 1.2 million.
1.2 million. And please mute yourself. Are you sure it's 1.2 million?
It's 60,000.
Okay, 60.
60,000. Okay, 60,000. Then what will be the current amount at the year end? We just subtract to get a current amount. So this will be the current amount at the year end. So this is what we get. Then we need to present our statement. We need to present our statement. So first we bring the name of the entity. What's the name of the entity? 𝐼𝐵 Limited. We'll show you the 𝐼𝐵 Limited. Then we show statement of what? Profit or loss for the year ended 2018. What do we bring here? Yeah, we're going to show our depreciation. We'll bring our depreciation figure here, which was 60,000. The next thing we are going to do is statement of financial position extract. First OCI. left the OCI, and bring the OCI. We had a revaluation surplus again. We had a revaluation gain for the building. We had a revaluation gain for the land. So we need to bring that. Let me bring it a little down. So statements of OCI for the year ended 2018. The depreciation should be shown as negative. Let me bring that. Then we show the revaluation surplus or gain, revaluation gain. And here there were two for the land. The land is 1.2 million. And then we add that of the building. The building is 1120,000. We add the two together. What do you get?
Get 320,000.
2,320,000. That's great. That's great. That's great. Okay, next let me do the excess depreciation that we spoke about so that we don't come back to it again. So excess depreciation, how do we get excess depreciation? Remember, the formula is new depreciation, which is after the revaluation minus old depreciation. So what's the new depreciation after the revaluation? That's the 60,000. After revalue the assets, the depreciation we had is 60,000. What is the old depreciation before revaluation? The accumulated depreciation of it is 320,000. Yeah, we just need it for 1 year. So if it's for 1 year, so let's do it without the 10 years, without multiplying by the 10 years. What would be the depreciation for just 1 year? If it's just 1 year, how much is that? That will be 32,000.
32,000.
So yeah,
Yes.
if you are calculating for the excess depreciation, it's going to be the new depreciation, which was what? The 60,000 minus the old depreciation, which was the 32,000. So what's the excess depreciation?
28,000.
28,000. Yeah, 28,000. So as I said, you do that one in statement of changes in equity or statement of net assets for FR students.
And
And for that one, we do them in using headings. So we need to have a heading for revaluation, surplus, and that of retained earnings. We need to have a heading for that. Let me bring the carousel. And then what do we bring here? So yeah, we already have revaluation surplus from OCI. So we need to bring it. The revaluation surplus we had from OCI. We'll bring that amount of money here. In the question, we're not giving retained earnings. We're giving a retained earnings balance. We're giving
Please no.
no, so that will be zero, eh? In terms of the balance. In terms of the balance, that will be zero. So we don't have anything for that. The next thing we do is we bring the excess depreciation. So usually we call it transfer. So if you check the full statement, we usually call it as transfer. So we bring the excess depreciation. How do we go about it? We say the excess depreciation are going to less from revaluation surplus. Then you send it to what? Retained earnings. So we check the excess depreciation we had was 28,000. We less it from revaluation surplus here. Then we add it to retained earnings. to get their respective closing balances. So let's calculate for the closing balance. This one will be 28,000. What about the revaluation surplus? We get what,
290.
29. Are you sure?
2292.
2292. Okay, thousand. Then we come to the statement of financial position. So we first start with non-current assets, our PPE value. So what is our PPE value? We look for the current amount at the end of the year. This was the value. We'll show it there. The next thing we have to do is to show equity. We need to bring out equity figures. So equity figures here, we bring revaluation surplus here, the closing balance that we had. Then we will show the retained earnings balance as well. If there's questions on this particular question, let me know. If you have concerns, question on this question. Yes, go ahead.
And the truth is 40,000. I thought was just for the building.
Yeah, we have to.
Maybe
Yeah, right. So we have to add it to. Yes, you're right, you're right. So 340 plus the land owned. The land revalued amount was, I think, 1.6.
say no 1.2.
Are you sure it's 1.6?
Um,
Yeah, so let's add it to.
Three.
3 what?
394.
Okay.
9.
Three.
3947.
Okay, that's correct. Kennedy, I saw your hand up. Do you have a question?
Sir, please, I want to find out, is it always that you solve and you get revaluation surplus? Sorry, the depreciation.
I don't understand you.
Yeah, I'm saying that is it always that we work and we will get excess depreciation or
So I said excess depreciation you only get when you're doing the revaluation method. And then you should only bring it when the question requests for it. If the question doesn't tell you to do it, don't worry your head with that. Yeah, Helen, go ahead.
So what if the current depreciation is lesser than the previous one?
It doesn't happen because of the revaluation. It doesn't happen. The asset values is always revalued upward. So in real life, it won't
Okay,
happen. Esther, go
it
ahead.
can be possible.
Oh, I've not seen some before.
Okay, so please, is there when the question asks for it? You say, will it be stated explicitly that maybe prepare extract of the statement of changes in equity, or when we see the phrase about the transfer, it indirectly
That's what
calls
I'm
for
talking about. I'm
that.
talking about the phrase. if you see the phrase before you do the excess depreciation.
Yes, please.
Any other question?
Sir,
Yeah, Daniel.
please, you mentioned a phrase. What kind of phrase is it?
So when you say that a company's policy is to make an annual transfer of realized amount to retain earnings. Well, yeah, they negated it. So yeah, they say Japan does not. Yeah, even they make it a Japan makes transfer to realize profit in respect of excess depreciation. So in any of them, if you see this, the company's policy is to make annual transfer of realized amount to retain earnings, or you see the other one in a positive way. Do you get it?
Okay. Yes, please. So, sir, does it mean that if none of the phrases appear, if none of them appear, you
You do
wouldn't account
excess.
for excess
Exactly.
depreciation?
Exactly.
Oh, okay. Okay. But you still have to prepare a statement of changes in equity.
If you have to.
Okay.
Any other question? Oh, okay. Since there's no question, let's move to the next part of our discussion. Derecognition or derecognition of PPA. Derecognition of PPA. When do we derecognize an item of PPA? So we derecognize an item of PPA when two conditions exist. Number one, when the carrying amount of an item is derecognized on disposal. So number one reason is on disposal. When you have sold the asset, then you have to derecognize the item of PP. Number two is when no future economic benefit flows from its use or disposal. Once the asset is no longer giving a value, then you need to derecognize it from your books. So in a case whereby any of this happens, there's a need for you to account for what we call gain or loss. Gain or loss on disposal. How do you get your disposal gain or loss? You bring your net disposal proceeds and then you less your carrying amount. So this is the formula. Bring your net disposal proceeds less your carrying amount of your assets. That's how you get a disposal gain or loss. So now I'll usually tell you that whenever you are doing this disposal, there are two major things you should do, even sometimes three major things you should do. Number one, you account for your disposal gain or loss, which the formula has given to us. Number two, you need to write off the cost of the asset, any related cost item. That's the carrying amount. You need to write off the carrying amount of the asset from your books. Number two, you need to write off any related benefits of the asset from your books. Any related benefits of the asset from your books. When we say related benefits, we are referring to revaluation. We have steady revaluation. So we can realize that we can get revaluation gain or revaluation surplus in respect of an item of PPE. So when you derecognize an item of PPE, you need to write it off as well. How do you write it off? Just remove it from the books. So if it's a retained earnings, how do you remove the retained earnings? Revaluation surplus. You just remove it from revaluation surplus, just like we did for excess depreciation. So remember, just like we did for excess depreciation, it's also a form of transfer. You remove it from the revaluation surplus. If there is disposal, then you add it to retained earnings. So these are the treatments. So these are the three things you should take note of. Number one, how to get disposal gain or loss. How do we get that? bring your net disposal proceeds. That's the amount of money you got when you sold the asset, less the value of the asset. That's the carrying amount of the asset. Number two, dispose of it or write off its cost and accumulated depreciation. Basically, write off its carrying amount of the asset from your books. Then the third one, write off any benefit you derive from the asset. And what's the benefit you're referring to here? The revaluation surplus. So if an asset has it has a revaluation surplus, a balance or revaluation surplus, you transfer it to retained earnings. So these are what basically I was talking about in terms of theory. These are what I was talking about. Number one, you need to account for the disposal gain or loss in statement of profit or loss. So if you get disposal gain, it will be an income in statement of profit or loss. If you get disposal loss, it will be an expense in statement of profit or loss. That's the first thing you do. Number two, saying that if there is any balance on revaluation relating to that asset you have disposed of, then you transfer it to what? Retain earnings. You transfer it to retain earnings. You transfer it to retain earnings. And yet, it's just giving you a note that this doesn't relate to, or this does not affect your other comprehensive income. No, it won't affect your other comprehensive income. It rather affect your revaluation surplus in statements of changes in equity and that of your retained earnings in that regard. A hand was up. Esther, your hand is still up. Do you have a question? Okay. David, your hand was up previously. Do you have a question?
Please, I wanted to ask if under disposal we don't actually have um revaluation gain, but we have a revaluation loss. Do we also how
Revaluation
do
loss.
we
We don't keep balance for revaluation loss. Do we keep balance of revaluation loss as equity?
say no if it's in the P&L?
Yeah, so if it's in a P&L, what it means is that you have expensed it. That's why we take it to P&L.
Oh yeah, true. Yeah, thank you.
Yeah. Yeah, David, go ahead.
Yes, with regards to the deal recognition, I wanted to ask if the accumulated depreciation is equal to the cost of the asset. Can't you also deal recognize the assets as well?
So that's this condition. That's the second condition. Do you get it, David?
You'll also be keeping the assets in the books and
David,
uh,
did you
like stating it. Hello.
David? Yeah, I get your point.
Yes.
I, I'm saying that that's the second condition. If the accumulated depreciation is equivalent to the cost, it means there's no economic benefit from that asset, right?
Yes.
Yeah, so you do recognize the
So
asset.
but they still keep it in the books. That is why, even though may not have effects.
So if you don't have effect, why should you keep it in your book? So write the value of.
Okay.
Any other question? Okay, then let's move on to our questions. Yeah, Isaac, go ahead.
Okay, sir. So in a case where you're preparing final account, and then the requirement there is no comprehensive income. You're only preparing P&L, and then there is revaluation gain. Do you do you just move up straight away and treat it in the statement of financial position, or you ignore it at all?
Sorry, I don't get your question. Oh. That's your question
I'm
again.
saying that in case the requirement is that you prepare statement of financial position, not statement of financial position and other comprehensive income. But there is
Financial
also,
position. Did you say position?
sorry, financial profit and loss.
Okay.
Yes. So In the requirement, there's no profit or loss and other comprehensive income, just profit and loss. But in the footnote, you have revaluation surplus. How do you treat it?
In the footnotes, you have evaluation surplus.
So you have revaluation surplus, yes, but
So
the requirement it has the requirement for you to prepare other comprehensive income.
there's no requirements.
Yeah, the
So
requirement is just profit and loss or profit or loss.
so if it's profit or loss, just do your profit or loss and go.
So I should ignore the how do you call it? The revaluation surplus.
Where are you going to send it to?
So
Okay.
I think
Now
it will go statement of financial position.
Exactly. You're not doing statement of financial position. By your question, you said you're only doing
oh,
statement of profit or loss.
yes, that's what
So
I
if
was
you
asking.
if you're doing only statement of profit or loss, and just do what will go to statement of profit or loss and leave the rest. Whatever
Okay,
you
sir.
see in demand for it. Okay. So let's go to our last question for the day. Arida, please read for us. Helen, you're reading for us, right? Helen, are you there?
Okay, let me read, sir.
Sir,
Can I read?
Yeah, go ahead.
Hello. All right.
okay.
The job purchased
Explain.
a property. All right, required. Explain and illustrate how the
Are you done
disposal.
reading the question?
No, I'm going to read the requirement first. Or I should start with the question.
Yeah, start with the question.
Okay, so the job purchased a property costing 3 million Ghana cedis on 1st January 2016 with a useful economic life of 10 years. It has no residual value. At 31st December 2016, the property was valued at 3,240,000 Ghana cedis, resulting in a gain on revaluation being recorded in other comprehensive income of 540,000 Ghana cedis. There was no change to its useful life. Jijo does not make a transfer to realize profits in respect of excess depreciation on revalued assets. On 31st December 2018, the property was sold for 3,600,000 Ghana cedis. Explain and illustrate how the disposal on the property should be accounted for and how the previously revalued assets be treated in the financial state in the financial statement for the year ended 31st December 2018.
Okay. Thank you very much. Yeah, we're asked to explain. So there are certain things you need to bring in your explanation. Number one, you state the standard applicable. Number two, you tell us which aspect of the standard we are looking at. Number three, the measurement rules. And then number four, tell us that the calculation is shown below. So, for instance, this one we tell us that this question falls under the ambit of IAS 16, property, plant and equipment, or Ipsas 17, property, plant and equipment. This relates specifically to disposal of a non-current asset. In this case, you need to account for disposal gain or loss, statement of profit or loss, and then any revaluation surplus in respect of the asset needs to be written off into retained earnings. The calculation is shown below. Depending on the marks, you can elaborate further or reduce the elaboration. But at least there are key things we need to see. The standard should come. Which aspect of your standard we are looking at specifically? The measurement rules should come. And then you tell us that the calculation is shown below. Then go ahead with that. I hope you're fine with that.
Hello, sir.
Yeah, go ahead.
Yeah, please, sir. When we were talking about the aspects, Is it because there's a clause of disposal, like on 31st December 2018, the property was sold for 3.6 million. Just because of that, is that the main reason why you are saying it focuses on the aspects of disposal?
Yeah,
Why, sir?
because that's the main focus of the question to me. Yeah, there was revaluation, right?
Because I was
There was revaluation, right? The revaluation, they've even given you the
yes,
value. So
please.
they've given you the value, so you can choose not to calculate for it. Have they not given the revaluation gain?
They have, please.
So if you are to do the revaluation, what will be the value? The value has already been given to you. So the main work is at the disposal.
Okay, 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 sir.
Yes, that your hand was up.
Sir, please, I've seen my answer in the slides.
All
Thank
right.
you.
So let's make progress. So let's come to the disposal aspect. So yeah, what do we do? First things formula, how do we get a disposal gain or loss? So you say to get your disposal gain or loss, you bring your net disposal proceeds and then less your carrying amount. So yeah, first thing is that we need to get a carrying amount of the assets. So to establish understanding, let me start, although yeah, this question we can start somewhere, but let me start from scratch. So that to establish understanding, let me start from scratch, from the 1st January. So the asset value on 1st January was 3 million, the property value. So let me start from there. That was the cost of the asset on 1st January. That was 2016. The value was 3 million. Then when did revaluation occur? We're told that revaluation occurred on 31st December 2016. So yeah, we have to calculate for depreciation for how many periods? How many periods are we calculating for depreciation?
12 months.
Just for 1 year, right? From 1st January 2016 to 31st December. That will be 1 year, right? So we do that for 1 year. So we bring the costs, the assets, we divide by useful life. The useful life of the assets were giving us 10 years. Then what will be the depreciation in this case? 300,000.
300,000.
Okay. We subtract to give us the carrying amount. So this will be the carrying amount. This will be the carrying amount of the assets. Then we bring the revalued amount. So the revalued amount at that date was 3,240,000. So we bring the revalued amount at that same date. So this was 31st December 2016. That was 324,000. So we compare and check whether we have a revaluation gain or a revaluation loss. So let's check.
Again.
Again, 54,000, right? 540,000. So let's see whether it's the same thing given to us in the question. Was it the same?
Yes, sir.
Yeah. That's why I said, yeah, we can skip all this process. But I just wanted us to see how they had their 540,000. So this was their revaluation gain. Then they move on to say that the asset was disposed of on 31st December 2018. So we bring the value of the assets as at 1st January 2017. What will be the value of the assets on these dates?
324,000.
340,000. So bear in mind, after the revaluation, the new current amount will be the amount. So 324,000. Then yeah, we need to calculate for depreciation up to when the asset was disposed of. So from 1st January 2017 to 31st December 2018. How many years is it? How many years is that?
Sir, please come
2
in.
years.
That will be 2
2
years.
years.
Yes.
Yes.
So we calculate for accumulated depreciation for 2 years, right? So we bring the value of the asset 3,240,000. Then we divide by remaining useful life. What's the remaining useful life?
9 years.
9
Say
years.
8 years.
It's 9 years. So remember the total useful life was 10 years. And we have only charged 1 year depreciation. That was the 300,000 for 2016.
Yeah.
So it's left with 9 years. So we do that. What do we get? I can't hear you.
360. 360.
360,000. Then we calculate for the carrying amount as at that date, 31st December 2018. Coming, we are calculating for how many years? We said 2 years. So let's do it straightforward. Or
Yes.
should we do it one by one?
No, times 2.
You let me do it one by one since you have already done this already. Then we calculate for the depreciation again. For the next period. And the depreciation will be the same because of 2 line method of depreciation. So it will be 360. If you still want to calculate for the depreciation, you get the same amount. So for instance, if you want to calculate the depreciation, so someone will bring 288, and then now you divide by 8 years. You can calculate that and see whether it's the same. Do they get the same thing?
Please.
Yes, it's the same.
It's the same thing. So the value of our assets will now be this minus this. Then we compare with this net disposal proceeds. So how much did we get when we sold the asset? We need to bring the value.
4.6.
So we got 3.6 million. So bring 3.6 million. We compare to see if we have a revaluation, a disposal gain or a disposal loss. So do you have a disposal gain or a disposal loss?
Gain.
Disposal gain. So we bring the net disposal proceeds minus the carrying amount. That will give us a disposal gain.
Other is low.
Yeah. When you're done, you need to prepare your extract in that regard. First, you bring the name of the entity. I think it was Israel. Then prepare our statement of profit or loss. Let me see the year. Preparing for only 2018. Then what do we show here? We'll bring our depreciation for 2018. Depreciation only for 2018. That was the
20.
360,000 we had here. Then here we had a disposal gain. We report that one here. So that was basically it for 2018. Then we have statement of changes in equity. The reason I'm preparing a statement of changes in equity is because of the revaluation surplus we have.
Hello, sir.
Yes, please.
Also, the question stated something like it's not transferred. Please, can we check the question again?
Yeah. Yes, I get you. But don't forget that we have a revaluation gain.
Oh, okay.
So the reason we are doing this is because of the disposal. Remember, I said when you dispose of an asset, you should dispose of the cost and benefits, right? I
Yes,
said
sir.
here, I said any balance on revaluation surplus, you should transfer to where? To the retained earnings.
Oh, okay. Okay.
So that's the reason why we're preparing a statement of changes in equity. Do you get it?
Yes, sir.
So here we bring the balance brought down for the revaluation surplus. That was this value, 540. It was also given to you in the question. We're not giving that of the retained earnings. So that will be 0. Then we do the transfer. But this transfer is in respect of what? Disposal. So we need to write off this 540,000 here. And then write 540,000 here instead. So here will be 0. And here will be 540,000. Then you bring it as a closing balance. Balance carried out. Then we come to the last statement. Statement of financial position. Yeah, the property doesn't exist again, so you don't bring non-current assets. It doesn't exist again. The only thing you're going to bring is your equity. And the equity, the only thing you're going to bring is retained earnings. Is the 540 you had here. We understand? Did we get it?
Yes, sir.
Okay.
Is there a question? Yes, no, go ahead.
Sir, please, I want to establish what I've learned. Sir, so if we see the statement does not make transfer or does make transfer, it just calls for excess depreciation presentation in the statement of changes in equity. But
Come again.
any other,
Come again. Come again. What you said, the ending was conflicting with what you said at the beginning. Come on.
I said that when we see the transfer to realize profit in respect to excess depreciation. That statement, whether it is does not or does, it just calls for calculation of excess depreciation in the statement of changes in equity. And then maybe other
No,
transfers to
no,
also
no,
call.
no, no, no. If it says does not,
Okay.
why will you calculate for it?
So I'm saying if if it does, we'll calculate for it. If it does not, we'll not calculate for it unless there is another transfer in the question, like this question.
Okay.
Severely do get me.
Unless there's a transfer like this question.
Like the treatment for disposal will call for a transfer to the retained earnings or new valuation gains relating to that asset that has been disposed. So despite there is do not make transfer to realize profit, of which we would not have prepared changes in equity, but because it's disposal and it has revaluation surplus with respect to the asset being disposed, we have to prepare